Welcome back to More Fun with Finance. I'm Dr. William Elliott coming to you from my studio in beautiful uptown Shaker Heights. This is the lecture for Chapter 12 out of Ross, Westerfield, and Jordan. And so let's get right to it. And I'll get out of the way and get the slides loaded here. So this is beginning to look at some of the asset pricing models. But before we get there, we've got to cover some of the basics. So we need to learn how to calculate a return. We need to look at the historical returns over long periods of time. We're going to both look at the average as well as the variability in those returns to get some sense of how much return we get for a given level of risk. And then we'll cover the difference between geometric and arithmetic returns. And then finally, a short overview into market efficiency. All right, so this part should be relatively simple. We're just calculating a return for a equity here, and we're assuming that this particular equity pays a dividend. So here, to get our dollar return, we're looking at two components. We're looking at a income component, that would be, in this case, our dividend, and we're looking at a capital gain or capital loss, which would be the change in the value of the stock. Now, in this example, we've got Video Concept Company, and we're assuming that the stock was selling at $37 per share when we originally bought it. We bought a round lot, and that is 100 shares. By the way, it's interesting to note that in today's world, the vast majority of trades on the market are actually for one single round lot. That is only 100 shares. So even if you're trying to move a large block of shares through the market, you're going to break it up into smaller orders and scatter it across time. Reason being is that you're actually trying to hide from the market, right? If you're a seller and you're selling 10,000 shares of a company, that might suggest that there is some negative information about that company, when indeed maybe not. Maybe you're just selling it because you need liquidity, you need some money. But nevertheless, if you break it up into small 100 lot or one round lot portions, that is 100 shares, then it's easier to disguise your trades. It might take a little bit longer, but that's what algorithmic trading is for. It's all done with computers. You don't need to sit there and submit orders one after another. Now, this particular stock paid a $1.85 dividend during the time that we held it, and then we later on sold it. So the dividend total is $185. Now, we sold it a year later, and we sold it for $40.33, and that means that we had a $3.33 gain times the 100 shares gives us a total dollar gain of $333 for the capital gain. Put that together with our dividend right down here, and our total dollar return is the sum of the dividend, 185, and the capital gain, the 333. Then if we wanted to look at returns, percentage returns, we could do that as well. We're always going to use that initial money invested. It seems obvious when we're talking about stocks, but when we would get into calculating returns, say, for instance, on an option or something of that nature, or on a futures contract, then it's not quite so obvious. But we're always talking about that initial dollar amount that we have invested at the beginning of this. So in this case, we initially invested $37 to get, and by the way, we're going to break this percent return up into two components as well, just like we did with the dollar return. So first off, we're going to calculate the dividend yield. This is a really important number, and a lot of people will look at this for virtually every stock that they invest in. If it has a very high dividend yield, that might make it more attractive to investors who are, say, retirees, and they don't really want to sell any shares, but they do want that regular income, and so they look for high dividend yielding stocks. In this particular case, $1.85 on a $37 investment gives us a 5% dividend yield, which is a little above average. Typical dividend yield is in the 2 to 3% range. So this might be a stock that would interest somebody who is, already retired. The capital gains on this as a percent, again, we're going to take that $40.33, subtract off the 37 to get the actual gain, and then divide it by 37. So that's 333 divided by 37 gives us a 9% gain. And actually, I apologize. I'm going to have to, I'll correct this before I upload these slides. But this right here is incorrect. This is actually P at time t plus 1, not t sub t and plus 1 outside of the subscript. So that would be the time that we sold it is t plus 1. The time we bought it was one period prior at time t. Let's see, this is just a graphical representation showing us with the purchase back here at time t. We held it. We're assuming that the dividend actually was paid just before we actually sold the stock. And so we sold it, well, first we got the dividend and then we sold it for $40.33. And if you want to look at it in a formulaic way, dividends paid at the end of the period plus the change in market value divided by the beginning price. And given that this is 100 shares and we're looking for percentages, we could get the same percentage by just looking at the percent return on a single share, or we could do it for the entire 100 shares. Saves a little bit of time if you're just looking for a percent return to do it on a single share, though. Here's another example. In this particular case, we're talking about buying a stock for $25 per share, and then at the end of the year selling it for $35 per share. We're also assuming that we receive $2 per share in dividend. And here we are going to look at both the dividend yield, the capital gains yield, the percent return, total investment of $1,000, and how much did we have? Or rather, if our total investment is $1,000, how much did we have at the end of the year? So dividend yield, very simple, $2 on a $25 investment, that's 8%. Cap gains yield is, again, this, sorry for these subscripts, that's messed up as well. That should be that P to the subscript T plus 1. So that's simply the $10 gain divided by $25, or a 40% return there, right down here. So together, we have a 48% return. That's the dividend yield plus the cap gains yield. And again, graphically, this is what we end up with. So hopefully that's relatively clear-cut and simple. Now we're going to get into looking at much longer time periods. We're going to go back historically and look at what returns have been on various asset classes. And an asset class is just a subdivision of all assets. So one asset class might be just all stocks, or what we also call equities. Another asset class would be bonds. We could also have an asset class called commodities, called real estate, currencies, things of that nature. And we can even subdivide the equities into finer gradations. So we could look at large cap or large capitalized stocks. Those are the very high value stocks, the Apples, the Googles, the Amazons, and so forth, versus small cap stocks. We might even split it into three. We might have large cap, mid cap, and small cap. We could add a micro cap even if we wanted to. But that's an asset class. It's a relatively large grouping where all of the assets within that class are relatively similar to one another. This particular division looks at large company stocks, that would be the large cap, small company stocks, long-term corporate bonds, long-term government bonds, U.S. Treasuries, and then we're actually going to throw in inflation as well. So here we've put all of these together onto one chart. Note that the beginning period here is 1925 and we end in 2020. So we have nearly 100 years of data here. And let me share with you before we get into the nitty gritty of this, and I'm going to get out of the way here so that I don't cover up this lower part of the graph. Before we get into that, anytime you're looking at a graph, these are called ocular statistics in the in the profession. And it's easy to lie with ocular statistics. As was it Mark Twain who said, there are lies, damn lies, and statistics. I would add to his list one additional category beyond statistics, and that would be ocular statistics. It's very easy to create a chart that presents a story as you want it to be told. And it may not truly be that way. So be careful. So here are a couple of tips. Always look at the axes and see what sort of units they are in. Notice, obviously, down here we have years on the x-axis, but take a look at this y-axis. Here we go from $1 to 10 to 100 to 1,000. So it's a log. The numbers on the y-axis are in logarithmic form. So what that means is that the higher values are going to be compressed. So when we look at these small company stocks and we see them performing just a little bit better graphically here than, say, the large company stocks right here, let's look at those numbers. Here we are nearly, oops, how did that change? Nearly 49,000, or a little over 49,000. Here it's only 11.5. So quite a large difference. And then down here, it looks like inflation and treasury bills track pretty closely. And actually they do. It's really $16.50 versus $22. But then we've got long-term government bonds in here. And they're obviously falling in the middle, but it's only $130 versus, way up here we've got that 11,000 and then 49,000. So that scale, it's important that you recognize that scale. Now, why did they do this? Well, they're not trying to fool us. They're just trying to tell us that, if we just plotted it on a normal scale, the only two lines we would see would be the small company stocks and the large company stocks, and the other three lines would be horizontal at the very bottom here. We wouldn't even notice any variation in them. So that's why they did this. But always keep an eye on the units that each axis is in, so that you know what's happening and you know why a line is where it is. Now, the other thing to note here is that it looks like these small company stocks have done just extraordinarily well. So why would we even bother with large company stocks? Well, the answer lies in another little thing in this graph that they don't talk about, and that is that how many of these small company stocks that start back here in 1925, how many of those stocks do you think are around here back once we get out to 2020? Yeah, I see a lot of you saying not many or none. Because if they were successful, they became large company stocks. And if they were unsuccessful, they probably don't exist anymore. So what's embedded in here is a lot of trading. So if we were to actually try to replicate these lines in real life and actually have a portfolio that represented that portfolio in 1925, and then we'd update it in 26 and 27 and 28 and so on. So we're updating that portfolio, we're rebalancing it every year. That means we're selling those stocks that went up to become large company stocks, and we are obviously rebalancing, buying some of the stocks that have been newly minted, new IPOs. That is all costly. Now, you might be saying to yourselves, yeah, but Dr. Elliott, the commissions that I pay on Robinhood or E-Trade are zero, so how costly could that be? And the answer is, you're absolutely right. Those are the commissions we pay today. But if you just go back 25 years, and better yet, obviously went back in the 1920s and 30s, commissions were double digits at least. And it was not uncommon in the latter part of the 20th century, before deep discount brokerage houses, that they might have even been $100 per trade. Even if you're just trading one share, $100 commission to trade that share. So that's quite a cost if you're actually going to replicate that. If you embed that in there, this 49,000 up here, you're not going to find that in reality. That's not there. It might be closer to 20,000 if you're lucky, maybe even less. It's very costly to trade over most of the span of this time. It's only been recently here where we've actually had the ability to trade with effectively zero commission. So that's another thing to keep in mind here. While this looks great, could we actually have replicated it? And the answer is probably not even close to the values that we're seeing here on the table. But let me get back to the main point that the authors are trying to make here with this graph, and that is to say that small company stocks have done extraordinarily well. Large company stocks have done pretty decently as well. Even long-term government bonds are not bad. Remember, this is beginning with a single dollar back here in 1925. And by 2020, we have $130. So 130 times what we had originally invested. Now, clearly, Treasury bills, that hasn't done so well. And inflation is eating away at some of that as well. So we've got to take that into account. All right. So they say, let's go into a closer look at these. So rather than looking at the whole period, on a single line, what they've done here is they've said, well, let's take and break it up by year. And so here, I believe we have our large company stocks right here. And again, this is 1925 to 2020. By the way, I meant to mention one additional thing about critical viewing of graphs and charts and things of that nature. And that is to say, one has to ask, why 1925? And why 2020? Well, 2020 is obvious. Whoever created these, they calculated it up to just the most recent year of data that they had. But why 1925? Well, our very commonly used database for these returns only begins in 1925. And you'll see that date over and over again. There are some other dates that are embedded in commonly used databases. CRISP is a database that finance researchers use widely. It's from the University of Chicago. It's the Center for Research and Security Prices. And the data there begins in 1960. So oftentimes you'll see people going all the way back to 1960, but no further. But that's a question you should always think about. Is somebody cherry picking a period of time to make it appear that the story they're trying to tell is correct? So always view these things with a critical eye. All right, back to the large company stocks. What we see is that, generally speaking, on a yearly basis, we've had some really high points, even here and here. The other thing to note is that many of these high points were followed low points right here. Not so much for this one or this one, but you can see back here during the Great Depression, stocks lost massive amounts of value in a given year, but then that was fairly easily recouped the following year. Back here we've got this is the global financial crisis, the GFC, and then here we have COVID. So you see these big downturns are pretty easy to pick out. Small stocks, small company stocks or small cap stocks. It looks like this top graph is more volatile, but don't forget, look at the axis. The max here is 60%. The max here is 150%. So always look at those axes. And again, just around the Great Depression, we see some pretty serious negative returns here, but then that's followed by a very high return. In fact, the highest recorded return for a given year in small company stocks. And again, the global financial crisis we see here back in the 70s, we saw some downturns just preceding 70. In the late 80s, there was also a period of time that had some problems right here. But all in all, it looks like relatively, a good return for each of these. We'll find out in just a moment what the average is, though. So hang on. And then let's also look at the bonds and the T-bills. So here we have long-term government bonds. And again, keep an eye on the axes, -30 to +50. And again, you'll note that, there's not as much volatility in these. However, they did take a pretty major hit here around COVID. And then we go down here to U.S. Treasury bills. And boy, there's nothing down here. What do you think that's caused by? Any guesses? If you said that Treasury bills have a life of less than a year, so you never have a negative return on them, you'd be right. That's exactly why there are no negative returns. Up here on the bonds, if the value of the bond has dropped and we're calculating an annual return on it, that's how we can get negatives here. That is, the value of the bond will drop when interest rates go up and vice versa. There's an inverse relation between interest rates and the value of the bond itself. So that's what's going on there. But again, note the axes. We've got 16% here. So back in the 80s, interest rates, even short term, spiked. Now, again, I won't go into a lot of detail there, but that was also around a period of time when prior to 1980, there were caps on the amount of interest that could be paid on regular savings accounts and things of that nature. And it was at that point that Congress passed the DID-MCA, that is the Depository and Institutions Monetary Control Act, and that removed the cap, and interest market or the bond markets had a great deal of difficulty getting a hold of what was going to happen. So that created this period of volatility in interest rates. Also of note, take a look over here where we have very low rates. So most of you have, during most of your lifetime, you haven't seen much in the way of interest rates. It's been very close to zero. So these rates that we're experiencing today are not really, relatively speaking, they're not that much higher compared to the long run. So when people talk about 4 and 5% being extraordinarily high, that's nothing. Think about getting a mortgage back in the early 80s when mortgage rates were 15, 16, 17, 18% on a mortgage. That's just brutal. Now, here we're looking at inflation, and again, notice that we're here at 20% to negative 15. And this period of time is relatively unique. Disinflation. It's not a period of time that we want to repeat anytime soon. We don't want prices to start to drop and possibly continue to drop. What that does is it creates some strange and perverse incentives in the marketplace. If I'm thinking about going out and buying a new TV or something, why should I buy it now? I'll wait a year and it'll be, 10% cheaper than it was right now. So disinflation is not a good thing, even though you might think that. Now, what is a good thing is a relatively low inflation rate. And the job of the Federal Reserve Bank, one of their key jobs is to keep inflation at or below 2%. Why 2%? Why not 0? Well, the answer is something I'll leave for my economist friends, but let me just give you a little bit of a flavor of it. Part of the reason is that the government has to make sure there's sufficient money in circulation such that any positive NPV projects are able to be undertaken by investors and entrepreneurs, by companies. Well, they want to err on the side of having just a little bit too much money to make sure that all projects that are viable are actually undertaken. So as a result, it's this 2%. I don't know historically where that number came from, but that is really one of the primary mandates for the Federal Reserve Bank, is to keep things around 2%. And as you'll note, over long periods of time here, they've actually done a pretty good job of it, right, in this period of time. Like I said, back in the 70s and 80s, there were some definite problems. Back after the war and actually during the war, World War II, there were some problems. And then, of course, what we experienced coming out of COVID was also problematic. But other than those shocks, the Fed has done a reasonable job at keeping keeping inflation at around the 2% level. All right. So here we're going to start calculating a mean or an average, and we're also going to calculate a variance and a standard deviation to get a sense of the measure of centrality for each of these asset classes, as well as a measure of dispersion. That would be the average and the variance, respectively. So for large company stocks, our average return annually has been 12%. And again, this is using that data from 1925 to 2020. For small company stocks, it's even a bit higher, 16. Long-term corporate bonds, 6.1. Long-term government bonds, 5.6. So that 0.5 or that 0.5% difference, what do you think's driving that? Let's say they're both the same term. Let's say they're both 20-year bonds. What's the difference? Yep, you're right. If you said the long-term government bonds are default risk-free, you would be correct. So it's that default premium that is being paid, that extra 0.5% really amounts to the fact that corporations can and do default on their bond issues, whereas at least to date, I don't know, they've tried it in the past. Maybe Trump will succeed, but Bill Clinton tried it. George W. Bush tried it. They talked about defaulting on a bond issue. The markets went nuts and they backed away from the cliff. But that's what the 0.5% difference is there. U.S. Treasuries are 3.3%, and then inflation has averaged 3% over this long period of time. So what is a risk premium? Risk premium is a very important concept, and this is a synonym with excess return. So excess return and risk premium mean exactly the same thing. Basically, we'll just subtract what we call the risk-free rate from the total return on risky assets. If that doesn't make any sense, let's just go over to this table, and it should make a lot more sense right here. So if we have a risk-free rate that is 3.3%, why U.S. Treasuries? Well, because the U.S. government has never defaulted on a Treasury bill, or for that matter, a Treasury note or a Treasury bond. But we always want to look at the Treasury bills here. We're using that as our proxy for a risk-free rate. In other words, it's a guaranteed rate. Well, if we subtract that from the 16% return of our small company stocks, that means that we're getting 12.7% risk premium for buying and holding a portfolio of small company stocks or small cap stocks. Likewise, with large cap stocks, the risk premium is 8.7, corporate bonds 2.8, long-term government bonds 2.3. So to get that risk premium, again, we're simply taking the total return of that particular risky asset and subtracting from it the risk-free return. We can also look at the dispersion around this average return. And here you see a representation, a histogram, that is, of which years had a particular return. So the way to read this is if we go down here on the x-axis, let's look right here in the middle at the 0. So between 0 and 10% return, all of these years had a return that was between 0 and 10%. And then these years had a return that was between 10 and 20%. These years, 20 and 30, and so forth. Over here on the left-hand side, we have between 0 and negative 10, these were the years, and so on for negative 10 to 20, and so forth. The worst year, 1931. That is out of the years in our sample here from 1925 to 2020. The best years, 1954 and 1933. So how do we actually calculate this measure of dispersion or volatility? There's a statistic called variance, and the square root of variance is called standard deviation. So let's take a look at how we actually calculate that variance, and to get their standard deviation, we always simply take the square root of variance. So suppose that we had this series of returns. So 10, 12, 3, and negative 9%. We're first going to get an average, so we simply add them all up, divide by the number of returns, and so we get an average of 4%. So the variance is simply the squared deviation from the average or from the mean, summed up, and then divided by the number of observations minus 1. I won't go into the long explanation of why the minus 1, but you can think of it as, it's called a degree of freedom. 1 degree of freedom is subtracted. And the reason we subtract that is that these 4 observations are obviously a sample out of a population of many more observations. Well, if we only have 4 and we're calculating a mean or an average with those 4, maybe we're getting that number wrong somehow. Well, that degree of freedom is an attempt to take that error in calculating the average into account here. So that's why we subtract the 1. All right, so if we actually look at the calculations here in this table, Here are those same returns right there. Here is the average. When we subtract that average from each one, so 0.1 minus 0.04 gives us 0.06, and then we square that 0.06 to get 0.0036. Everything is similar to that for the other three. The one that might be a little bit confusing is negative 0.09 minus 0.04. That's why we have a negative 0.13. And actually, this one helps us to understand why are we squaring this? Well, we're squaring it to get rid of the negative sign. If we didn't square this, we'd add these things up and they'd come out to be relatively close to zero, and that would not give us a measure of dispersion. So when we square it, notice that that becomes a positive value. We add all of these guys up and we get 0.0270. All right. Then we're going to divide that by 4 minus 1, and we're going to get a variance of 0.009. Now, 0.009 doesn't mean anything to us, and the reason it doesn't is that we just squared a return. What's a squared return? If you're scratching your head, yeah, you're right. There is no such thing as a squared return. So we take the square root of that to get it back into percentage terms. So when we take the square root of 0.009, we get 0.09487, or in percent terms, 9.487%. Easy peasy. And that's why most of the time when we talk about dispersion, rather than talking about variance, we're typically talking about standard deviation. All right, this is just showing you a regular formula to actually calculate that variance. And then to get the standard deviation, we simply take the square root of the variance. And even if you're doing this on your calculator or on a spreadsheet and you use a function that gives you standard deviation, behind the scenes, that function is actually calculating variance first and then taking the square root of it. There are no shortcuts to that. Here's another example of calculating first an average and then a variance. So we've got two companies. We've got SuperTech and we've got Hyperdrive Return. First, we're going to calculate the average, then the variances, take the square root of that to get the standard deviation, and then try to determine from that which of these two stocks is riskier. And so down here, we're calculating an average. And so SuperTech has an average return of 17.5%, whereas Hyperdrive has a return of 5.5%. And then in this table, we're calculating a variance. And so we have the actual return for SuperTech right here. Here's the average that we then subtract from the actual return for each year. And then over here, we square that value. And then we sum all of those squared values up. And we divide by, again, the 4 minus 1 degree of freedom, or 3. And we come up with a standard deviation of 29.86% for SuperTech. We run a similar process for Hyperdrive, and we find that it has a standard deviation of 13.28%. So then the question is, which of these is more volatile? And clearly the answer is that SuperTech is much more volatile than Hyperdrive. Looks to be like double. The standard deviation is more than twice that of Hyperdrive. However, here's the thing. We're getting a much higher return for SuperTech than we are for Hyperdrive. How do we decide which of these stocks actually is providing us with the best return, because the more volatile stock has a higher return than the less volatile stock. So what you're going to find is that later on in the semester, we're going to calculate a measure of return per unit of volatility. And then we'll be able to tell which of these stocks actually provides a better return given the volatility. So we can't quite answer that question just yet. Going back to that historical record, what they've done here is they've put all of the asset classes together. We can see that clearly the most volatile would be our small company stocks, followed by large company stocks, a little bit less volatile, and then corporate bonds considerably less volatile, long-term government bonds a little bit, not too much different really, frankly, and then intermediate bonds as well as short-term bonds. Intermediate would be notes, and short-term would be bills. And then finally, inflation down here. What we found is that many series follow normal distributions, or at least closely resemble normal distributions. And here we have a normal distribution right up here. And as you probably all remember from your statistics class, one standard deviation either side of the mean encompasses about 68% of the entire distribution. Two standard deviations encompasses about 95%, and three standard deviations encompasses about 99%. Another thing to note here about a normal distribution is that it is symmetrical, meaning that the left side is similar in shape to the right side. In addition to the symmetry in a normal distribution, we can use that normal distribution to give us a sense of the range of returns that we might experience and put some probability on that. So if, for instance, we wanted to know 68% or just a little more than 2/3 of the time, what would a large cap portfolio return? Well, if we know that the average return is 12%, and the standard deviation of those returns is 19.8, one standard deviation either side is going to yield a range from -7.8 to +31.8. And that means that 68% of the time, our returns are going to fall between those two bounds. By the way, I apologize for the click-clack in the background. My German Shepherd producer was just leaving the room. So the second lesson to take away here by looking at this historical record is that the stock market's volatile. In any given year, we can have massive losses if we have an equity portfolio. And for instance, in 2008, the S&P 500 index fell 37%. Well over 1/3 of its value lost in a year. And in fact, if we look down here, between November 2007 and March of 2009, the S&P lost half of its value. Imagine you put $500,000 in on November of 2007, and you come back and look in March of 2009, and you find out that you've got $250,000 in your portfolio. That's not a good thing, especially if you're near retirement or in retirement. That would be devastating. That means that maybe when we're in retirement, we shouldn't take quite so much risk. And the answer actually is, yeah, you shouldn't take quite so much risk. And more on that in a little bit, but it's not a given that you shouldn't invest in risky assets, but you may want to attenuate that because you have less ability to make up for it than if you're, say, in your 30s and you lose half the value of your portfolio. You've got another 35 years or better for that to be made up. And not only that, but you could also make changes in terms of how much money you're putting in your portfolio as well. So those are some ways to deal with that. And that's why at a younger age, you're able to take on greater risk and still end up with a portfolio that has quite a bit of value at the time you need it when you retire. Now, when those stocks went down in 2008, what did better? Well, bonds, particularly treasury bonds. The reason that they did better was known as a flight to safety. So when the stock market was making these wild moves, especially downward, where do people put their money? Bonds. And not just any bonds, but government bonds, because I'm worried about default. If a company's stock drops and plummets, the reason it's plummeting is that its sales have gone down probably and its profits are down. So maybe it won't be able to pay the interest payments on its bonds or repay its principal when it's due. So the type of bonds I want are default risk-free bonds, and that would be U.S. Treasuries. Here's just an example of returns in the year 2008. It was a scary year. I do remember the market dropping below 7,000. It had been at a high, and when I say the market, I'm actually referencing the Dow Jones Industrial Average. It had been at a high of around 14,000, and it had dropped down to below 7,000, less than half of the value just months before. And at that point, why not just buy? Because if it continues downward, you're not going to need money. You're not going to need stocks. You're going to need two things, or maybe even just one: food and guns to protect your food. And if you don't have any food, all you probably need are guns to try to take food from somebody else. I know that's a little dark, but bottom line is when the market drops so much, more than likely it's a buying opportunity. Now, there are exceptions to that rule, and if you look at the Japanese stock market, it's taken decades for the Japanese stock market to recover back to where it was 40 years ago. The U.S. market's been more resilient and had a much quicker recovery. It's not to say that it won't change. I thought I would show you, while we're talking about market volatility, I thought I would show you this spreadsheet here that I have. This is really more of a personal finance type of demonstration here for you. What we're looking at is a projection of the returns that we will get and the value of the portfolio that we will get if we put some money in every year on a monthly basis, and we hold that portfolio in 100% equities, and we keep that investment for 35 years. So we're going to start off by putting in $300 per month, and every year we're going to increase that. So $300 for the first year per month for the first year, it means that we put in $3,600. And then the next year we put in $3,600 plus 10%. Divide that by 12, and that gives us our monthly investment. But you get the idea. We're assuming that we started with no dollars in the account. We're going to ignore the bond rate, but we're assuming that equities on average, and I emphasize average because that's a number that comes out of the distribution, the normal distribution of returns. It's the measure of centrality, right? We're assuming that that average is 9%. We're also assuming the volatility, that is standard deviation in this case, sigma, is 10%. All right. So those are our inputs. And what we're going to do is each year we're going to go to that normal distribution with a mean of 9 and a standard deviation of 10. And we're going to draw a particular return out of that, just at random. And we're going to put that on year 1. Then we're going to go back for year 2, and we're going to draw another return, and that will be our year 2 return. We're going to do that another 33 times, so we have 35 returns. And then we're going to calculate the money that we would have saved over that 35-year span. Now, because we're putting in $300 every month for the entire 35-year span, it means that we actually will have put $1.073 million into the account. That's our out-of-pocket expense. So hopefully we end up with something more than that. And since we're putting everything into equities, unless we were in Japan and had that 40 years of the market going down and only recovering just recently, we would hopefully have more than $1 million. But the question is how much more than $1 million? What's surprising here is that the variation in our portfolio value outcomes is quite high. So in this particular series of returns, what we see is that the ending value of our portfolio is just a shade over 3.5 million. And that is driven by, if you go down here, you'll see the actual returns that we got in our portfolio. So for year 1, we had 3%. Year 2, we had 26. Year 3, we had 21, and so on. We had a couple of negatives in here, but generally about a typical series of returns over that span of time, right? Last year was 17%. All right, let's go back up here. Now, I can just hit the F9 key and I can recalculate. In other words, what I'll do when I hit F9, that's going to go back to that distribution 35 more times and draw a different series of returns. And then I'm still, going to recalculate the portfolio value. So let's do F9. Now we got 3.2 million, or 8.5% average. How about again? 3 million, 2.6, 1.7. Whoa. Now that's quite a bit lower. That's just over 5% return on a annualized basis. That's a really bad outcome. But we only live through one of these 35-year spans, right? Remember, we don't get to choose this. It is what it is over that 35 years that we're investing. And our 35 years might be this one, where our $1 million investment only yields an extra $776,000. Not good. What if we do it again? There's 2.1, 2.4, 3.2. Now that's over the average. That's 9.5%. 3.6, that's 10%. Let me keep going. There are a few times, I was going to say there are a couple of times where I actually got up to 6 million. And here's one of them. 6.5 million. That's the series of returns I want to live through, but I don't get to pick. That actually is over 13.25% over a 35-year span. That's incredible. But if we go back down here and we look at that series of returns, I'm sure we'll see a lot of very high double-digit positive returns and very few negative years. And lo and behold, yeah, that's exactly what we're seeing here. Multiple years where we've got 20, 20, 28, 20, 23, 20, 30, 19. Is that likely in the real world? Yeah, I guess it's possible. I mean, is it going to always fall in that sequence? In the real world, maybe not. I'd be very skeptical that 6.5 million is a realistic outcome. But certainly you could get some variation. Um, and the reason I'm skeptical about that is that the business cycle often jumps in there and causes us. It's usually a fairly short window, even though lately we've had a very long business cycle. But you can see that each outcome is quite different. I'm just hitting F9 each time here. We almost got up to 7 million in one of these, but we've gotten a low of 1.7 million. Let's see if it'll drop even lower. There was another 1.7, 1.9, 2.9. You get the idea. So when you're investing for your own retirement, keep this spreadsheet in mind. You don't always get the average. Even over a span of 35 years, it may not be the average that we typically think of. If you see that you're 15 years in or 20 years in and it looks like you're running below the average, what do? Yeah, you're right. Put more money in so that you can achieve your goals. Or I guess you could scale back your goals too. But you need to keep that in mind. Now, you don't want to watch your portfolio every day or every week, but certainly you want to take a look at it every 6 months, maybe every year, just to make sure that you're on track with what you had planned and that you're going to be able to meet your goals and your financial goals that you have set for yourself. Okay, so let me jump back in here to the slides. And let's talk a little bit about this section of the chapter where the authors talk about the market risk premium. And they say this: some argue it has been too big and overestimates what is likely to occur in the future. This is highly debatable, and I don't want to come down on either side of this, but it's very possible that that risk premium has shifted. There's a great deal of depth one could go into to studying that, and many of my colleagues look at that. I'm not an asset pricing person, but that's the area of study that tries to determine, is the market risk premium time varying, or is it constant over time? We don't really know that, and part of the problem is we only have this one world to study, and the factors that are important keep changing, and we don't know exactly what they all are, and so forth. A lot of hand waving here. So take this with a bit of a grain of salt, but it's possible. And so ultimately, are you going to get the same return? I think the real question here is, are you, over the next 50 years, going to get the same return that has occurred over the prior 50 years? And the answer is obviously, we don't know. Honest answer is, we don't really know. So there are no crystal balls out there. But what we do know is that if you just put all of your money into a savings account, you're not going to be able to retire at the same level that if you put it into corporate bonds and corporate equities and things of that nature, higher risk investments. So more than likely, that is still something you'll be able to count on. Here's the section where we talk a little bit about different types of calculations for a return. We can calculate a return two ways. The way we've been calculating a return is called the arithmetic average. But there's another method called the geometric average or geometric return. Now, arithmetic average, you simply add up all of the observations and divide by the number of observations, just like we've been doing. Geometric average does something a little bit different. And let me show you an example to prove to you the problem here. And that is, suppose that we buy a stock for $100 and we're going to hold it for 2 years. The first year it drops to $50, so it loses half of its value, 50% loss. The second year it has a 100% return. In other words, it doubles its value. But note here that we bought it for $100 and we sold it for $100. Now, if we were to calculate an arithmetic return on those 2 years, we would take a negative 50% down here, look to the bottom of the slide, add it to the positive 100% return, and divide by 2. When we do that, you get 25%. Wait a minute, what the? Yeah. That's not what we experienced, is it? We experienced 0% return. So 25 is grossly overestimating the, now this is annual, still annual, but it's grossly overestimating what we experienced. Let's look at the geometric return. When we actually calculate, and I'll show you shortly what the math is behind this, but when we use a geometric average to calculate the return, we end up with 0% return, which is exactly what we experienced. Now, this wide variation between geometric average and arithmetic average occurs in a situation like this where we have vastly different returns over the period of time. So some really high returns followed by some really low returns, or vice versa. That's where these two deviate the most from one another. In many cases, though, when returns have just small amounts of volatility from one period to the next, the geometric average and the arithmetic average are pretty close to one another. So it almost, in those cases, it doesn't matter. But you should know this regardless. So to calculate the geometric return, instead of just adding all of these up, we're actually going to take the decimal equivalent and we're going to add 1 to each return. So if, for instance, we have an investment with 10, 12, 3, and negative 9% return over a 4-year span, we'd take that 10%, that the decimal equivalent is 0.1, add 1 to that. Take the 12% return, take the decimal equivalent, 0.12, add 1 to that, right there. Likewise with the 3%, and then the negative 9, we get the decimal equivalent is negative 0.09 plus 1, gives us a positive 0.91. And then we're going to take that to the 4th root, or the exponent is 0.25, which is equivalent to the 4th root. Why the 4th root? Because we have 4 observations. If we had 5, we'd take it to the 5th root. If we had 6, we'd take it to the 6th root, and so on. And then that result, we still have to do something else to it. We have to subtract 1 from that result. And in this case, you'll end up with 0.0366, or 3.66%, is the geometric average for that series of returns. Grab your calculators, take them out, and just run through this math to make sure that you're comfortable with doing that. You can do the 4th root by just using the y to the x function on your calculator. If you have a BA2+, and the y to the x function is right here on your BA2+. So just use that. And so you would have the result of what's inside the parentheses hit the y to the x button and then enter 0.25. That would take the fourth root of it, subtract the 1, and hopefully you'll end up with this same result here. But run through that math just to make sure you got it down. In a more generalized form, here's the formula for calculating a geometric return. And just another example of doing this computation with a series of returns here for the S&P 500. And so we're taking the decimal equivalent of 11.62%, add the 1 to it, so that becomes 1.1162, multiply it by 1 plus the decimal equivalent for 37.49, so on until we get down here to the 1.5158. We take that to the, since we have 5 returns here, we take that to the fifth root, or hit the y to the x button and enter 0.2, and then subtract your 1. And you should end up with 8.67% out of that. Again, run through a couple of those just to make sure you're comfortable with that calculation. Okay, so if we look back to figure 12.4, where we're looking at those various small cap, large cap, corporate bonds, treasury bonds, and so forth, what we saw was that $1 invested in 1925 would grow to be $11,535.21 by 2020. And so if we use this geometric average to calculate that, we would end up with, obviously this is the 11,535.21 raised to the 1 divided by 97th power. And then we're going to subtract 1 from that, and we end up with about a 10% return. And that's quite different from the average return we calculated, which was 12%. So there we do get some sort of a difference. Now, when do you use the geometric average and when do you use the arithmetic average? The answer is provided for us right here. Obviously, geometric is going to bias things downward compared to arithmetic. But when should we use each? Well, if we're looking at a long period of time and we want the annual average, a geometric average is more than likely going to be closer to what we actually receive over a longer period of time, say 20, 30 years. If we're looking for the return in a typical year, that's when the arithmetic average is going to shine. So long periods of time, use geometric. Shorter periods of time, the arithmetic is close enough. And there's actually a formula to allow us to deal with that called Bloom's formula down here. And they give some examples in the book. I'm not going to spend time in lecture looking at those examples. You can take a look at them. But here is the formula right here. So we're going to take t minus 1 over n minus 1. Now, well, first let's start with n. N is the entire span of time in our population of returns where we've calculated a geometric average and an arithmetic average. So n might be 50 years. T is the holding period that we're going to hold a particular portfolio and we want to calculate an average annual return for. So it might be we're holding this portfolio for 5 years or 10 years. What can we expect? So when you plug in the numbers, what you find is that a 1-year holding period is going to be exactly equal to the arithmetic return. And a 5-year holding period is going to be a little bit lower. 10 years is going to be lower than that. And a 20-year is going to be very close to the geometric average. I think this formula is fine if you want to use it. Here's the problem with this formula. It's suggesting way too much precision given the lack of accuracy that we have. Um, really, we're forecasting this stuff as I mentioned earlier in this lecture. We don't even know if the risk premium is time variant, and whether it's going down, or as we move further into the future. Is it decreasing? And the answer is we don't really know. Now, I would guess that it will not decrease a lot, because when we look at the variation in wealth rather than the variation in returns, we find that the variation in wealth over long periods of time maintains. It doesn't approach zero, whereas the variation in returns does approach zero. But that's a lecture for a more advanced class. I won't get into that at this point in time. Okay, here we're getting into the last part of chapter 12. They talk about capital market efficiency. This is a topic that we could spend the entire class on, or easily the entire semester even, if we wanted to do a deep dive into this topic. It's an extremely important topic as well. Market efficiency, simply put, means is all of the information that's available being incorporated into the price, or does the price take account of all the information that's available? And that's important because, well, we want, if a company has new information show up, well, then the price ought to change to reflect that new information. If it's good information, that probably means the price will go up. If it's negative, probably means the price will go down. But if it doesn't, if markets are inefficient, that's another question. Then when we're buying, do we know that we're buying at the right price? Maybe it's too high? If we're selling, are we selling at a fair price? Maybe it's too low. So market efficiency is a very important topic, and it's been studied for decades by finance researchers. Now, this particular section is just fairly short, so it'll be a very quick overview. We're going to start off, though, with an example here, and this is with this F-Stop Camera Corporation, ticker symbol FCC. And this particular company has developed a new technology that is going to double the speed of autofocusing available in its cameras. And this is obviously going to be a very positive thing for the company. Autofocusing has always been a problem in the camera world. So what we find here is that we're told that this is definitely a positive NPV project. So that means for sure the value of the company will go up. Now, right now, nobody else other than insiders in the company know about this, and those insiders have not been allowed to trade. That's another topic that we delve into when we talk about market efficiency. I'll just give you a short version of it here. Insider trading is not illegal. There is a form of insider trading that is illegal, but many insiders trade quite legally. Obviously, they have to. I mean, if we're giving them stock options and stock grants, they may want to sell some of that at some point in the future. So it has to be legal at some points in time. The time when it is not legal is usually when there's a lot of asymmetric information between shareholders and insiders. Well, like this particular example right here, where we're talking about this new technology that's going to revolutionize autofocusing, going to be a huge value bump for the company. But right now, the stock price doesn't reflect it because that information has not been made public. And not until that time can the price reflect that. Another little thing I want to mention here is that how does information get into prices? If you said by trading, you're right. That's the only way it gets into prices. More demand than there is supply will drive a price up. More supply than demand will drive prices down. And it's simple Econ 101 stuff. So in this case, when this is announced, there will be more demand. So here we have the share of stock in FCC. What's it going to do when this is made public? Well, let's take a look at this next slide here, because they announce it, and we're going to call the announcement day day 0, actually, because we've got a little graph over here on the right side of the slide that we're going to look at in just a minute. But before the announcement, FCC stock was selling at $140 per share. The new, the new project has an MPV that should increase the value of the company by $40 per share. So the price will ultimately be $180. Now, in the real world, we don't know this sort of thing. It's uncertain. But in this particular example, let's just pretend for the moment that it's actually a $40 increase. All right, so let's go over here and look at this graph, because this is really easier to understand when we look at this. An efficient market would follow this line right here and go up immediately on the day of announcement, and then it would level back out until there's more new information. Well, not all markets are efficient, or at least not to this level, right? Just for the reason that I just mentioned, the uncertainty. I mean, most projects, we don't know for sure that it's going to increase it by $40 per share or $30 per share. So there's always some guessing going on, and what often happens is what we see either by this dotted line right here or by the dashed line here. So this dotted line is what's called an overreaction. It overshoots, so we have the price coming along here, it reacts, and actually it overreacts, but then eventually it comes back down to the level. And that would be that $180 price. Another possible inefficiency would be that it slowly goes up to that price. It doesn't react immediately, but it starts to go up on the announcement day, and eventually it reaches 180. Another form of market efficiency is that if some of this information leaks out of the company prior to the official press release of this new technology, we might actually see the price start to creep up ahead of time, and it still could overreact and then come back down. You get the idea. The perfect market condition is really this one that we see with the orange, or that burnt orange line. That's a perfectly efficient market. Now, are we ever going to get there? The answer is no. And in fact, because we have these insider trading rules that make certain periods of time where it's illegal for insiders to trade, that actually slows down the information getting embedded into the stock price. But we're okay with that as a society because we want the markets to be fair, right? So why should the insiders get the advantage? And so that's why insiders are prohibited from trading just before new information is released. But as soon as that new information is released, then they too can trade along with the rest of the public. All right. So that example is a great example of what market efficiency is. While we're talking about market efficiency, I thought I'd bring a relatively current example for you to consider here. What I have here is the Bloomberg terminal open, and I'm doing a graph of the price series, and the graph the company that I'm plotting here is GameStop, and the ticker symbol for GameStop is GME. You see that up here. You can see some other information about GameStop, its current price. Actually, the market is closed right now, so that's not live. But and then I've got historical prices all the way back to middle of 2020 here. So, and by the way, these are high prices for the day. These are not closing prices. So let me tell you a little bit about what happened here with GameStop. And you'll notice in particular over here, the far left, how low that price is. You can see that it's about $1.93, $1.30. But what happened with GameStop is that GameStop was a company, and it is a different company now. So we're not talking about the company as it is in 2025. They've made some changes to it as a result of this short squeeze that occurred. And I'll tell you what that is in just a minute. But what was happening back in 2020 and prior to that was that this was a bricks and mortar store that basically sold video games and things of that nature. It wasn't doing particularly well, as you can tell by the price. And by the way, I should also mention that if you read any articles about this, which I'd recommend that you do, it's a kind of an interesting story. You might notice that they talk about prices considerably higher than what you're seeing on this plot, and that's because they did a stock split in 2022. I think it was in July of 2022. They did a 4-for-1 stock split. Actually, it was officially accounted for as a stock dividend, but I'm getting way too much into the weeds there. But nevertheless, the current price now is 1/4 of what it was. And so what Bloomberg does on a chart like this is, instead of seeing the price jump up all of a sudden back in 2022, they actually show it as though it was had split all the way back before that. So they show it with basically what we could do is back in 2020 or 2021 or before July of 22, we could multiply the price by 4 that we see here on the plot. And that would give us the actual price that was that you would have observed in the marketplace at that time. All right. With all of that aside, what this the short squeeze. Okay, so how do we get into that? First off, we have to have some investors who short the stock, and this happened to be a couple of hedge funds, and they saw that GameStop was not going to do well. It was going to continue to decline in value, so they took up fairly large short positions. Now, let me describe briefly for those of you that aren't familiar with a short exactly what that is and how it works. You know how to buy a stock long, right? You simply go out and buy 100 shares of stock and you buy it a certain price. And if it goes up, you make money. So you buy low, sell high, right? Well, a short position is exactly the same strategy, buy low, sell high, except we reverse the buy and the sell part. So we try to sell high first, and then we buy back at a lower price later. Well, how do you sell if you don't own the stock? Well, let's just go out and borrow it from somebody who does own the stock with the promise to repay it in the future. All right. So now I have stock and I can immediately sell it. So these hedge funds were back here selling this stock for, $4, $5, $6. They were borrowing vast quantities of shares and dumping it into the market at these relatively low prices, with the expectation that the price would continue to go down, and that here in 2021 they could buy it back for maybe $1 or $2, and they would make a very large profit off of that, because we're talking about hundreds of thousands, if not millions, of shares that they were doing this with. All right, roundabout beginning of 2021, a number of retail investors, average small investors, people who might be buying 50 or 100 shares, they happen to get wind of this short position that these hedge funds had taken out, and they happen to like GameStop, and said, well, gee, why don't we try to force the short positions out of the market? How do you do that? Well, if you can drive the price up, that's going to cause the shorts to start losing money. And because they borrowed these shares, eventually they're going to have to pay them back. So that means they have to have enough money to buy back the shares at a higher price. If the market moves against them, they'll have to buy back at a higher price. So what happened here is that these retail investors got together on a subreddit called Wall Street Bets. So if you're not familiar with Reddit, Reddit is just a discussion forum, and it's just a vast array of topics. But one of them in particular is called Wall Street Bets. So all of these individual investors got together on Wall Street Bets, and they said, take as much money as you can afford and buy GameStop, buy GME. And they did that. And what they did was they were able to drive the price up to $10, $20, $30. And all of a sudden, these hedge funds said, whoa, wait a minute. We got to get out of our positions. Well, how do you get out of a short position? Well, to get out, you've got to go out and buy the stock back and then give it back to the person that you borrowed it from. Or you sold it, rather, at $5 back here in 2020. And then you're having to buy it back at 10 or 15, you're losing a lot of money because we're talking about hundreds of thousands, if not millions of shares out here. But here's the other thing that buying back those shares does, is it drives the price up even further. And so what happened right here, this big spike right here, is where the short squeeze occurred. Because all of a sudden the price started to spike. And that was these hedge funds closing out their short positions. Rather than lose even more money, they said, well, we're going to cut our losses and get out, but that drove the price up. Eventually, it got up here to, it looks like just about $500. So about $480, $490 for the peak here before it started coming back down. Now, it didn't last long, and it fell back down quite a bit. Back down here to, about $50, 12 times 4 is 48-ish, somewhere in that vicinity. But then even during the rest of 2021, there was a lot of action in this because this particular stock just got tons of press coverage. The Wall Street Journal, go to the Wall Street Journal, you'll see article after article about the GameStop short squeeze. And so what it did was it caused the value of GameStop to, or rather the price of GameStop. Let me be very careful about the choice of words there. It caused the price of GameStop to go way up. Now, this didn't have anything to do with the value of the company itself. The value of the company hadn't changed. The company was still just a brick and mortar retailer of video games, effectively. Now, lately, they've changed their business. They've gotten into crypto and some other things that they're doing, and I don't want to talk about that right now. That's not my point here. Here's my point, is that this deviated, the price deviated severely from true underlying value. That's very inefficient. Now, even the Wall Street Journal was kind of applauding, hey, the little guys won this one. They beat Wall Street. Well, yeah, okay, I get that, and that's fine. But what I don't like is that this makes the market look like not a very fair game. It makes it look like it's a rigged game. And that's not good because that has a negative impact on society and as a whole. Because if I think that the market is not a fair game, I may not put as much money into it. And if I don't put as much money into it, not only will I be poorer, because I'll put it into a lower yielding investment, maybe even a savings account. Maybe I put it under my mattress. But then here's the other problem. The companies that need capital to grow aren't going to find that capital as available. And if they do, they might have to pay more for it. And as a result, economic growth is going to be stymied. So it could have these wide-ranging effects. So while I applaud, letting the little guys win this one, and that's great, I guess, but ultimately is that really good for us as a society? And I would argue no. So, and there were a number of these other what they call meme stocks that got really high press coverage and drove the price through the roof, way above true value. And everybody knew it, but they were still playing this game, trying to find somebody who is a bigger fool to buy it at a higher price from them. And a number of the small investors made quite a bit of money off of this particular short squeeze. There were also some that lost quite a bit. You know, if you bought in like right here, you probably sold somewhere down here or over here. You didn't make much money on that. You lost quite a bit of money. So there were also quite a few losers in this situation. But this is an example of a meme stock. AMC was another one that got a lot of press during the same period of time. And we've seen this with other stocks. There are a number of other stocks out there that not as well known, that trade well above any reasonable valuation. There's just no possible way that GameStop was worth $100, much less $400 or $450. So market efficiency is very important. It is not something we want to trifle with, and this is not something that we should look for. We hope we don't find any more of these. All right, so that's GameStop. This efficient market hypothesis, EMH, is really what we typically test. There are literally hundreds of studies that test this efficient market hypothesis. Typically, we find that markets are fairly efficient, and I'll be more specific about the level of efficiency here in just a minute. Okay, so there are three thresholds that we typically look at when we're trying to assess the efficiency of a market. One is called weak form, the second is semi-strong form, and then the third is strong form efficiency. So let's look at each one of these in turn. So we're going to start with weak form efficiency. And really these thresholds have to do with how much information is reflected in the price. So if markets are weak form efficient, what it means is that if I look at the historical price series and the historical volume of a particular stock, and I analyze the heck out of it, and I use all kinds of sophisticated modeling techniques and algorithms, and I can't make more money than the expected return after calculating in all the trading costs and all of my time and the computer time and the cost of the data and all of that, then markets are at least weak form efficient. What it means is that what's known as technical analysis is a fool's errand. You should never do it if markets are weak form efficient. Semi-strong, and remember, everything has to do, we're assuming that all of this information is out there, all of the price series, all of the public information, all of the privately held information. It's out there. The question is, related to these thresholds, is how much of that information is actually reflected in the price of the stock. And if it's not reflected in the price of the stock, then it means I can use that information to make abnormal returns. That is money that I should not be getting if markets were efficient. So weak form efficiency simply means that I can analyze the heck out of the price series and the volume series, and I still can't make more than the expected return. I can't make abnormal profits on it. Now, if markets aren't even weak form efficient, there's actually a fourth category that nobody really talks about, but they may not even be weak form efficient, which means that technical analysis is something that I could use to make abnormal returns. All right? Semi-strong form efficiency says, okay, markets are at least weak form efficient. In other words, I can't make money by simply studying the price and the volume series. But what if I added all of the other publicly held information that's out there on the interwebs, on books, and every source that I can possibly find? And I analyze the heck out of that. And if I still can't make abnormal returns, then markets are semi-strong form efficient. The last category says all of the information from the first two categories. We can't use that to make money. What if I had insider information, private information, something that only one other person on the planet knows that has some value implication for a particular stock? If I still can't make abnormal returns, then markets are strong form efficient. Now, I always think about this last category, this strong form efficient, as kind of a straw man because markets will never be strong form efficient. The reason is that in order for price to reflect that private information, that individual who holds that private information has to trade on it. And if they don't trade on it, it can't possibly know that. It doesn't just happen by osmosis. So that's really kind of a straw man that's set out there. Gene Fama came up with these categories many years ago, and markets will never be strong form efficient. In fact, we have laws on the books that prevent that from happening, that make certain types of trades by insiders illegal. Otherwise, maybe markets could be strong form efficient or close to it. Most of the research, actually, I take that back. That's not quite true. They would still not be entirely strong form efficient because there's one insider that might make money, right? Most of the empirical research that's been done tends to find that markets seem to be semi-strong form efficient, meaning that we can study the price series, we can study the volume series, we can use all other publicly available information, and we still cannot make abnormal returns. And I hear some of you asking, well, what about all these active portfolio managers? How are they making abnormal returns? Are they? Are they doing it consistently? Again, there's a lot of studies that have looked at this. And if we had the time to do a deeper dive on this, and you may see some of this actually in 5551 when you take that class, but more than likely you definitely see it if you took an investments class. The answer to that question is that it's difficult to make abnormal returns, and some of these managers who make abnormal returns one year or the next don't make them the years after that. One of the worst things you can possibly do is to go to, look at any of these end of year lists of the portfolios, the mutual funds that have done the best in a particular year, and put your money into that. Oh, that's a fast way to lose money, right? Because that's what everybody else is doing, and all of a sudden those abnormal returns are going to go away. So the semi-strong form market efficiency is where most of the empirical research suggests that we are. Now, the real conundrum here, there's a bit of a conundrum, right? Because if nobody did any financial analysis or security analysis on the value of these companies, how could prices possibly reflect the true value of these companies? But if everybody does analysis, a lot of us are wasting our time, right? So you see many of these large cap stocks that have 20 and 30 analysts following them. That's a lot of analysts, even for a fairly complicated company. Do we really need 20 or 30 analysts? I would argue the answer is no. But there may be other reasons for an investment bank to put an analyst on following a particular stock. It may be that they're trying to curry favor with that particular company so that that company will do some business with them, with the investment bank. doing security issuances, looking at various types of projects, acquisitions, mergers, things of that nature. So there are some reasons for having that many analysts following it, but they don't necessarily need that many analysts to figure out what's this thing worth and how is that changing over time. So the conclusions here, just to wrap up the chapter: prices appear to respond rapidly to new information, and the response is at least not grossly different from what we would expect in an efficient market. In other words, it looks like an efficient market. Future market prices, particularly in the short run, are difficult to predict based on publicly available information. So that's another thing that you can fairly well count on. And here we're talking about S&P 500 type stocks. And then third, if mispriced stocks exist, then there is no obvious means of identifying them. Now, again, this applies to S&P 500 type stocks, large cap and mid to large cap stocks. If we're talking about mid cap or mid to small cap or micro cap stocks, forget about this. All of this goes out the window. And that's because not many people analyze those stocks. Maybe nobody. And they trade very infrequently. So it's very possible that if you analyze very small stocks or small mid-cap type stocks on the smaller end of the mid-cap range, that you can find some abnormal returns. Getting that information might be difficult, but it might be worth it if you get enough of an abnormal return. Now, the other problem, though, with those smaller stocks, and the reason that they're out there anyway, is that there's not much liquidity in there. So if you're a big mutual fund, it's not worth it. The amount of money that you can move in there and move back out without altering the stock price is pretty small, and it's not worth their time to deal with that. They can't buy 10,000 shares without driving stock price up quite a bit. They can't sell those 10,000 shares without driving the price down over the course of selling those 10,000 shares. So if you're out there looking for, some sort of analysis, focus on the lesser known stocks, those stocks that aren't followed already by 20 or 30 analysts. That's it for chapter 12, and I hope that you enjoyed it. And I'll also post in the section just below the video a video over in my investments playlist that goes into a much deeper dive here on market efficiency. Thanks very much. Have a good evening.